Hi, everyone. This is Shoshana Zatz from CIBHS. Welcome to the Small County Fiscal TA webinar with Mike Geis. I will turn it over to Mike in just a few minutes. Just to let you know, Mike will be pausing for questions throughout the webinar. And so if you have a question, please type it in the question box and we'll make sure to get it asked for you. We're recording this webinar. Should be able to have it up on our website by next week. So that we have the Fiscal Leadership Institute coming up on June 4th and 5th. So with that, I will hand it over to Mike.
Great. Thank you, Shoshana. Good morning. So today we're going to cover what was discussed at the April 5th Financial Services Committee meeting. And you can kind of see here the agenda that was discussed at that meeting. So diving right into the OIG report, as hopefully you're all aware of by now that the OIG conducted an audit of the Medi-Cal Specialty Mental Health Program. I believe there were 500 claims that they disallowed, and it wasn't every county that they looked at, so it was a small sample of claims. But then they extrapolated the findings to the entire system. The HCS has shared that report with CBHDA and CSAC, and then submitted a response to the OIG. And my understanding is, as part of that response, they identified 29 claims that were disallowed that were the state was questioning whether they should have been disallowed. So there may be some reduction in the amount of recoupment as a result of that. DHCS said that the final OIG report should be out sometime in the next 3 to 4 months, and that they are looking at how to allocate the recoupment among the counties. And then CSAC really wants to engage the state on whether or how the state can share in some of the repayment, because they don't feel that you folks should be responsible for the entire amount. And what DHCS talked a little bit about is the process. The way it works is that the OIG will issue the report identifying the amount of recoupment, at which point it's up to CMS to actually do the recoupment through their quarterly process through the CMS 64. And that process is generally that it's 60 days from the identification of an overpayment that the state needs to refund the money back to the feds, and that's defined at 42 CFR 433.300. So we would anticipate that process occurring. The question is, how then is the state going to recoup the funds from you folks, and how much should that be, and those sorts of issues that all still need to be worked out. And based on the timing of this, I think it's clear that in all likelihood, nothing's going to happen this fiscal year, that it will happen probably in the first or second quarter of fiscal year 18-19. So that was the update on the OIG. Any questions on that? All right. Then we had a fairly brief drug Medi-Cal update, where the state indicated how many counties. There's 11 counties, I guess, that are live now. Another 16 that are approved to go live, and they are reviewing 5 county fiscal plans. And this again was as of when the meeting was back on April 5th. They had released at that point about $101 million in total approved claims under the waiver since February 2017. And then there was a question that was raised by a county to the state that the state didn't respond to, which was surprising. But they asked, the question is, can you use any non-federal funding sources match under the drug Medi-Cal or under the ODS waiver? And the answer should be yes, as long as it's not used to match other federal funding sources. So you should be able to use your AB 109 funding or county general funds were the two, I think, questions that were asked. You're not limited to just using the 2011 behavioral health subaccount So anyway, that again, I'm surprised DHCS didn't just answer that in the meeting. So, and that was pretty much it on the drug Medi-Cal update. Any questions? All right. Then the state went through some of the new information notices that they had issued since the last meeting. The first one is DMH Information Notice 18017, which deals with mental health plan claiming for child and family team assessments. And there's a couple of key things to look at in here. We now have two new modes and service function codes, 1506 and 1556 for these services. And so that you can now, and here's all the taxonomy associated with the actual claim. And it goes through all the modifiers and everything else up here. But now you can begin claiming for these services, dates of service after January 1st, 2017. The couple of things is that you cannot, so these are, and the reason this is all separate and identified separately is because these are costs under Prop 30, where you're going to get some state general fund in addition to the FFP. And so, because these are new requirements brought on since implementation of the 2011 realignment. So anything that is related to what you were doing prior to the 2011 realignment continues to be your requirement and your responsibility to fund. And the state has maintained that the activities associated with KDA, the intensive care coordination and/or intensive home-based services, are part of your obligation prior to the 2011 realignment. So those you continue to bill at the same approach using the intensive care coordination or the intensive home-based services service function codes, and this is only for new activities related to what they describe here in this info notice. So that was info notice 18017. And actually, the other thing they did say is that they have an idea, DHCS, of what counties were doing in prior years with respect to these sort of assessments and activities. And if they see a dramatic shift, and so they're going to look at your data, under this claiming, and if they see a huge increase, they're probably going to question you in terms of, are you really appropriately claiming for new activities associated with the child and family teams, or is it something where you're just recoding it? And so anyway, just be aware of that. And I would say, you can kind of anticipate that sort of scrutiny on anything that we're now going to be getting state general fund monies for, that the state's going to take a pretty hard look at it. Ultimately, this gets settled through the cost report, and ultimately through audit. And so anytime state general fund's involved, it seems the state tends to take a little harder look. So just a heads up on that. And then the next notice was DMH Information Notice, or DHCS Information Notice 18016, which deals with the administrative day rate. And so this is the rate the maximum rate the state will pay for services provided in an acute inpatient setting that do not meet the acuity levels. And so, again, the admin day rate, it's basically when you can't find a placement for somebody who should be discharged from a hospital. And so the maximum rate you can pay is this administrative day rate. And it actually went down from $611 to $565 effective last August. And I believe the reason, and the state talked about how they changed the approach a little bit, because what they do is they take the SNF rate and then they increase it by 8% of costs associated with the ancillary services. And historically, that had been 25%. And I guess CMS questioned what's the 25% based on, and DHCS didn't have an answer, so they looked at actual data and found out that ancillary costs are more in line with like 16%. And so I'm guessing part of this decline is due to the application of a 16% ancillary factor rather than a 25% ancillary cost. So in any case, just be aware that it did go down in the rates you're going to get for these services. So again, ideally, you're moving folks out of hospitals once they're ready to be discharged into a lower setting, but that, as you know, is not always possible. And then 18015 is establishing a county contract rate in the short Doyle Medi-Cal system. And we actually talked about that on the last call. Again, this is something that probably doesn't apply to very many of you, if any of you, because this is just a way that the state will put a maximum rate in the system for your county contract providers when your county contract providers are basically the ones that are entering their own rates into your claims processing system, so that you don't pay the contractor more than, or the contractor doesn't bill more than what you pay them. And I'm not aware of any of the small counties that are doing something like that, so it's not real applicable to you folks. And then the other information notice was 18014 that goes through the revised allocation schedule for the MHSA funds. And you know, you can read through it, and there's a bunch of attachments that show the different factors that are used to calculate the distributions. But kind of the bottom line was they did not. There's a resource factor, which is the resources that counties receive for community mental health services, excluding FFP, and that was not applied appropriately to each county. They tried to line it up by county, and I guess when the data got copied over, it was off by a county. And in any case, the calculation did not work, and it was not appropriate. And so somebody caught that, probably looked and saw that they had more resources listed than they actually had received. And in any case, the state did a recalculation with the appropriate resources for each county. And kind of the bottom line is, from your distributions from August through December were at 1%, the incorrect percentage. In January, you received a different percentage that included making adjustments for all the incorrect distributions from August through December. And now the percentage you receive is the appropriate percentage, and you'll receive that percentage from February through July. And so you can look at that and figure out what percent you should receive for the remainder of the year. And then there was let's see. There was some other discussion, and it really wasn't, well, it's not an information notice. It's actually related to legislation around the MDAP, Assembly Bill 2393, that is legislation to clean up the Welfare and Institutions Code, because you're not required to charge Medi-Cal beneficiaries based on the MDAP. But if you read the Welfare and Institution Code, somebody could technically say you are required to do that. So anyway, there's some cleanup language around that. And the question was asked whether DHCS would be updating the MDAP schedule, which dates back to the 80s, and DHCS was not sure if they will do that as part of the legislation. So that's it for info notices. Any questions on any of those? All right. So then we went into the state and federal budget update. So the 2011 behavioral health subaccount discussion. So there's information notice 1818, which describes the distribution methodology for the 15-16 growth. So you'll probably want to take a look at that. Really, it comes down to two factors where half of the growth is allocated based on your 15-16 claims. So what percent of the statewide claims does each county represent? And then 50% is based on weighted Medi-Cal beneficiaries in each county. And this is the attachment to that. So you can see that they start off showing here's how much your total claims were. And again, this is both drug Medi-Cal and EPSDT, so full scope under 21-year-old Medi-Cal beneficiaries. And then each county's relative percentage of the statewide total claims. And that's how half of the funds were allocated. And then they looked at weighting the different Medi-Cal eligibility groups or MEGs. And so foster care, and the way they do that is they look at the claims versus and the member months, divide the claims by the member months, get you a per member per month cost. And when you compare them to each other, you can you get a weighting. And obviously foster care, beneficiaries cost a lot more to you folks than some of the other beneficiaries. Same with disabled when you look at this. So if you have a higher percentage of foster care beneficiaries, you have a higher risk of incurring costs for Medi-Cal, especially mental health services. So then they took these weights and they applied it to the member months, and it came up with a weighted member month for each of the MEGs or the Medi-Cal eligibility groups. Add them together and you get a total for each county, divided that into the statewide total, and that gets a percentage of weighted member months associated with each county, which is, it's interesting. It's different for sure than where the claims are. And so that's how the other half was allocated. You can then go to the summary, which takes the two numbers, based on the claims versus, and then plus based on the weighted member months, and you get the total. And so that just shows you how they came up with the amount that you received. And I forget when you received it, but it was a while ago. Then they also had this comparison percentage-wise, this percentage versus your allocation schedule for the 14-15 growth, which was done under a completely different methodology. So I understand why they did it so that you could get a sense of whether you had a higher percent or not. But that approach did not weight the beneficiaries at all. It just took what's your number of beneficiaries in each county, and that was how actually a large portion of this funding was allocated. So it isn't really even a fair comparison. It's a different approach. So, but in any case, that's how they came up with the growth distributions for 15-16. And again, I want to say I forget when it is, but it's already occurred. So it just gives support for how they came up with allocating your growth. They also said that they anticipate distributing the 16-17 growth next month. And it would basically be the same approach as what you see here with claims and the weighted MEGs, except using 16-17 claims data. So I would imagine that if you want to get kind of a sense, or at least a sense on half of it, I don't think this MEG stuff's going to change a ton, because I don't think the number of beneficiaries shift around that much. And so it's going to be primarily, any differences will be driven more by what were the claims in 16-17 versus 15-16. But in any case, they anticipate releasing that in May. The downside is by using 16-17 claims, it hasn't even been a full year, full 12 months that those claims would have been potentially submitted. So hopefully the claim set that they're using is relatively complete for the 16-17 growth allocations. And then, again, DHCS says they've got some ideas for rolling base. And that whole concept is that you take the prior year base, for example, the 17-18 base amounts that you receive, then you add in what the 17-18 growth distributions to come up with the 18-19 base. You can see here that with the distribution of the 16-17 growth, they're not close to distributing 17-18 growth, and there's issues if the state continues to try to tie the fiscal year of the growth dollar amount to the fiscal year of claims, which are two totally independent events. But if they feel a need to do that, then it's going to be difficult to do a rolling base, and it may lag by a year. Anyway, there's other alternatives, but in any case, they hopefully will get to that at some point, because it makes then projecting your distributions for the next year a little easier. And they're supposed to present that their ideas to CBHCA and CSAC. And then we talked a little bit about SAPD funding. I guess DHCS is working on a new reporting and payment process, and anticipate that they will release a new info notice next month. And this reporting and payment process will be effective next fiscal year. But a lot of this stuff I think is going to still stay in place. The quarterly reporting that you do is going to still be there, but they're looking on at doing some changes, which will allow, I guess, the state to track more carefully the distributions and so forth in the future. They also said they're still expending federal fiscal year 2017 grant award, and they're waiting for the federal fiscal year 2018 funds, which is usually, they usually receive those about this time from the federal government. So any questions on any of that stuff?
There is a question. Are the percentage fiscal year 16-17 growth the same as the fiscal year 15-16 percentage? And county anticipate the cash on hand by 6/30. Not sure what that means.
So the approach is the same, meaning that 50% will be based on the 16-17 drug, Medi-Cal, and EPSDT claims, and 50% will be based on weighted Medi-Cal beneficiaries. But because it's a new data set, the individual county percentages will change. So your percentage for the 16-17 growth will be different. However, given that you have nothing else to use at this point, I would probably look at the 15-16 percentages as a proxy for what your 16-17 would probably look like. But it will be different. I mean, because it's a different data set. And the other thing is the dollar amount's different. So the 16-17 growth is 98.36 million. The 15-16 growth was 66.694 million. So there's more money in 16-17 growth. But at this point, the only thing, because you have no idea what other counties' claims for drug, Medi-Cal, and EPSDT look like, because that's going to drive the majority, I would think, of the shift in percentages among counties. And the state said they're going to release it in May. So if that occurs, then yes, it would be, booked by June 30th. Is that going to happen? We've heard before where the state's going to do things and they don't follow through, or it delays by a month. But there isn't anything in writing saying this. It's just Chuck Anders talking at Financial Services Committee meeting. But I've heard it multiple times now. So would I book a revenue? I probably would, based on what they're saying. But I would also definitely for the May meeting, which is that next week or the following week, I would definitely grill into the state more on, is this for sure going to happen, especially if you really need the revenue to make your make your numbers work for the current year. Anything else, or? All right, then we got a little into the cost reports. And as they have been saying for a while now, that they being DHS, intends to settle these reports by the end of 2020, and that they're anticipating a normal process for the fiscal year 17-18 cost report. And for those of you who have been around a while, you remember they used to you'd submit the cost report by December. Within basically 12 to 16 months, you'd be doing the reconciliation, so that within 2 years, following the close of the fiscal year, you would have had a settled cost report. Now they're talking about 20 months, so a little less than 2 years, which is even, I think, faster than we used to have. But I also would anticipate that this is going to put more pressure on you folks to get the cost reports in fairly close to on time. So anyway, we'll see how it goes, and we'll see if the state again follows through. What they're talking about with some of the older cost reports that still have not been settled is that your analysts will go ahead and submit those or get them ready for audit, even if there are some errors that show up on the automated error report. And as all of you probably know, there's a lot of errors on there that are false errors, or errors that shouldn't even occur, such as you don't have a non-Medi-Cal mode opened up to a given provider or legal entity. It just makes no sense. So anyway, hopefully they will just go ahead and submit those on, and we'll move on with the process. Audits is going to have to increase the speed at which they conduct the audits. Obviously, if because once the settlement occurs, the state has 3 years to audit. And if they're settling these things faster, then the state's going to have to catch up with the audits. But the state isn't that far behind doing audits once something is settled right now. So the audits is actually a little ahead of the settlement process, because they're typically settling and then auditing within a year or two. So it won't be as much of an increase in terms of the speed of audits versus how the settlements are done. And then they said they're drafting an information notice with all these different dates for release sometime in the next 4 or 5 days. So we'll look for that and see what the dates say, and we'll see how it goes. Hopefully you're all aware that the 16-17 cost report, both the summary and detailed template, have been posted. I didn't look this morning to see what the most recent version was, but I think as of earlier this month, they had updates through the end of March. So you may want to make sure you're using the most recent template as you prepare your cost reports, and as you send those out to your contract providers to prepare their cost reports. And then DHS says they're working on the 17-18 template, and this is great if they actually come through and clean up the summary template based on some policy changes. Meaning that the 1994 is no longer applicable. Most of the 1908s, all that related to state general fund distributions are no longer applicable, and so removing those from the summary would be great. It would also eliminate some of the false errors that you guys receive. They said they're going to send the template to test counties in May, with the anticipation of posting by July 1st. I also understand that DHCS is going to be conducting cost report training in June. So if you haven't heard when those are, I would definitely contact your cost report analyst at DHCS and ask when the trainings are going to be scheduled. And actually, I understand one of them is being scheduled for the second day of the Fiscal Leadership Institute, which doesn't make a lot of sense. Um, and the other thing as you go to these trainings is you see the 17-18 template, and even we saw in the 16-17 detailed template. I think where we're going to see the majority of changes are going to be related to all these different little state general fund pots of money that they're starting to distribute, either based on direct service claims or for administration or UR, continuing care reform, the CANs, and PSC 35 implementation. So I would anticipate that we're going to see more detail around those areas. Anytime there's state general fund, like I said, we're going to have a lot more scrutiny, and we're going to have a lot more focus of the audits when they finally get to those, looking at those cost reports. So that was it for the cost report. Any questions, or anybody have anything to add on the training that's coming up? Nope. All right. Moving into MHSA. So 31 counties had submitted their 16-17 RERs, and there's actually a list on DHCS's website that they post the status. They also give that status to CBHDA, and I believe the OAC is looking at that as well at their meeting today. For most prior year revenue and expenditure reports have been submitted, so that's good. And the reason both of these are really important for you folks is that, under AB 114, as of funds that would have reverted as of last June 30th are reverted and then reallocated to you. And so you need to get your 16-17 RER in so that DHCS can calculate how much they show reverted, and then you can begin your planning for use of those funds. And so for those of you who have submitted your 16-17 RERs, you've probably received the second reversion letter showing that everything that the state calculated in accordance with AB 114. There have been some appeals, and the best I can tell, there's really two responses on appeals. Well, three. One is they accept your appeal, which I haven't heard that occurring very frequently. Then the second is that you didn't appeal within the timeline, so they're rejecting your appeal. And the one that they use most often is that they just reject it, and then they refer to the information notice. What was it? 16059 that describes the process without giving you a whole lot of detail. So, but again, I wouldn't focus so much on appealing unless it's way off and their numbers are wrong. And I know there's issues around trying to submit revised RERs and the state won't accept them, or in any case, in general, I would just look at this as an opportunity, deal with the AB 114 numbers, put it in a plan, and get it posted so that you can move on rather than trying to appeal. Because the bottom line is AB 114 basically gave DHCS the authority to do kind of whatever they want. And so if they reject your appeal, there's no like second level appeal or formal appeal or something like that. So, and I do believe some counties have met directly with the state on this, but I think it, unless it's way off, your best bet is to just kind of accept what they tell you and move forward. So DHCS did say they're developing an information notice for release in May. There's some things that were in the information notice 16059 that were somewhat vague. I think that the biggest one is that counties may not, it says that counties may not spend your reverted funds until your county board of supervisors adopts a plan to spend the funds. Well, does that mean that the expenditures have to occur after the effective date of the adoption by the board, or can your board adopt a plan effective back to the beginning, for example, of this fiscal year. And so all expenditures in the current fiscal year could be incurred under your AB 114 plan. So hopefully they'll clarify that because again, AB 114 gave DHCS the power to pretty much do whatever they want. DHCS has said they may withhold 25% of future MHSA distributions if you do not submit your plan under AB 114. And again, there's certain timing. So you need to have a plan which is either done in accordance with an update to your MHSA plan or as part of your annual update. You need to have that plan posted by July 1st. And then you can go through the stakeholder process at that point. Then you have to have it approved or adopted by your board. And then within 30 days after adoption, you have to get it to, I believe, both the OAC and DHCS. So for sure, you want to try to have something posted by July 1st. And I've heard a lot of counties are being somewhat broad, which is I would highly recommend in terms of your AB 114 plans, so that it gives you the ability to have some flexibility with respect to use of these funds, as while at the same time meeting the requirements of the statute. There also are some strategies around the use of AB 114 reverted funds, and this was talked a little bit about in the Financial Services Committee meeting, and really, so the AB 114 modifies the act, and for those of you that are small counties that have less than a population of less than 200,000, you really don't have a whole lot of concerns because funds subject to reversion after July 1st, 2017 now fall under this 5-year timeline. And so what that means is that your 15-16 funds, which under the old law would have expired at the end of this June, now you've got until June 30th, 2020. Well, that also is the same time as you've got to use all the funds identified through your AB 114 plan. So you've got some flexibility, and you're not rushing to get a bunch of expenditures done by the end of this fiscal year. But for those of you that are small counties, but your population is greater than 200,000, then your 15-16 funds for CSS, PEI, and innovation basically expire at the end of this June. And so definitely keep an eye on that and make sure you're going to fully expend all your 15-16 CSS, PEI, innovation, if possible, by the end of this June. The other thing I think that has caught some folks off guard was that DHCS basically, and they didn't come out really forthcoming and say this, and they could have, but they changed the reversion period for WET and CFTN. So this chart was posted back in 2009 on DMH's website. It was carried forward to DHCS's website, and it talks about when funds will revert. And so you had some workforce education and training funds that reverted at the end of last June, but you really had until the end of this June, based on this reversion of funds release chart, to expend the rest of the workforce education and training. Same with the capital facilities technological needs. We all thought we had till the end of this June to expend those funds. Well, the state has now changed the policy, and they're looking at the fiscal year in which the funds, and I wouldn't even say they were made available. It's almost that they're associating with prior fiscal years, and basically saying that all WET and CFTN funds reverted as of last June. And so, there's pros and cons with that. The pro is that, well, that means I've got until June 30th, 2020 to now spend those funds, which is great. But the problem is, unless you did a transfer from CSS to CFTN and or WET after that initial funding, you may not have funds in the current year to spend. And so again, this is why that clarification from DHCS around their interpretation of when you can start to spend these reverted funds. So if they're saying it's got to be after the board adopts until you actually post an expenditure, then anything, because I'm not aware of any county that's actually gone to their board and gotten approval, although I think there was one county that was that might have done that already. But in any case, it for sure wouldn't be back to the beginning of this fiscal year. So you're going to want to look at that because if you didn't in 17-18 transfer any of your CSS to either wet to the prudent reserve, basically, you still have time to transfer from CSS into wet and CFTN to cover any of your current year expenditures, because you can do that through just a regular update if you've already done your annual update, which case you just have to post it for 30 days and respond to comment. So anyway, that's a lot on MHSA. There was an MHSA boot camp that CIBHS hosted earlier this month where we talked a lot about this stuff. But hopefully you're staying on top of it and paying attention to it. And then the last thing, DHCS does intend to submit a regulation package. They said October, but I thought they said it was more towards the end of the calendar year, and it's going to go through public comment, and there's going to be, I would imagine, we'll have opportunity to not provide input into the regulations, but to definitely provide public comment, which they then have to respond to consistent with the regulatory process. So that was it that was discussed at the meeting. Any questions on any of that stuff? It's probably way more than you wanted to hear.
There was a question about whether there will be a cost report training at the Fiscal Leadership Institute, which I can answer. And the answer is that yes, we're having 2 breakouts, one on mental health and one on SUD cost reporting. DHCS will be presenting, and we are currently asking counties to send in any questions you might have that you would like DHCS to address during those 2 sessions.
All right.
Now, there's another question. Did AB 114 also apply to CFTN and WET?
Yes, and that's what I just discussed, in that any funds that DHCS deems reverted as of June 30th, 2017 will now fall under the AB 114. And that's again where DHCS changed what the former DMH policy, and they actually say that any former DMH information notices related to reversion when they are overridden by this new info notice. And they're saying, yes, CFTN, all your CFTN and all of your WET needed to be spent by last June. And if you didn't, then those funds reverted and they become part of your AB 114 plan. So yes, and again, this is why you guys need to get all your revenue and expenditure reports in through 16-17, because the state will provide you a calculation showing how much they deemed reverted for each of your different components, including workforce education and training and the capital facilities technological needs components. But it's critical to get that in as soon as possible.
Another question.
All right.
What is the time period from the point the RER is submitted to when the AB 114 letter is sent with the appropriation to the county?
I don't know how long they're taking. Usually, I would imagine since they got all the majority of the calculations done, that it's fairly timely. So I would think within a month. But I don't know. I'm not sure. I know initially it was somewhat slow. Obviously we waited until till December-ish to even see an info notice and see some initial calculations in January. So it took them a while to get going on it, but I think they're fairly responsive now. But again, you need to get your 16-17 revenue and expenditure report in as soon as possible so that they can do, even if, if you're, because there's parts of it, obviously, that you're not going to know for sure. For example, the Medi-Cal FFP, because that is subject to, cost settlement and then audit of your Medi-Cal, especially mental health cost report. But if you can at least get some proxies in for that, get the actual expenditures for each of your different programs within the components, they can then give you a plan to move forward, so the reverted amounts. But the specific time, I don't know. I don't know if they're, and I haven't heard them commit to they're going to get it to you within a month or anything like that. But it's also, they've got to do a report to the legislature, so the sooner they get it done, the easier that becomes for them. All right. Moving on to some revenue updates. So I've said to you guys before, the annual adjustment is known the first part of March, and it's transmitted, or there's a letter transmitted from Department of Finance to the legislature with the calculation. So the annual adjustment that's going to post this coming July is now known. It's $272.5 million. This is less than what I had anticipated, which was around $400 million, which was still a decline from the prior year, and was even less than what the state anticipated, which was $312 million. And what is so this is known. This 272.5 will get deposited in on July 1st, 2018. The one thing that is really kind of concerning is that this 272 million is basically based on the 2016 tax year, and so the 446 is based on 2015. This is 2014, and when you look at the calculations, there was a 6% decline in the amount of taxes earned by this tax from calendar year 2015 to 2016. And this is during a time when, the stock market's going up, housing prices were increasing significantly, and the economy seemed to be doing pretty well. So it's hard to understand why would there be a 6% decline in these revenues. And, again, it's very few people pay this tax, and so they're making their own personal decisions. And the only thing I could think of was in 2016, we had the presidential election, and that after the election, folks decided not to recognize certain capital gains and other things in anticipation of a new administration that's more favorable towards businesses and so forth. And so, therefore, we saw a decline in the actual amount of revenue earned by this tax. It then leads you into the next year, which is showing, this is based on the state's number from January, still less than what we saw, based on a 2015 tax year. So this would be based on the 2017 tax year. But again, I wonder if the same thing is going to come into play where, especially towards the end of the year, we knew what the tax reform that was going to be effective at the beginning of this calendar year, 2018, was. And in general, that is more favorable to folks. And so you're better off trying to push income into 2018 rather than 2017. So I wouldn't be surprised if this number ends up being overstated. I mean, that's a long-winded explanation. But and then the other thing that occurred was the cash transfers also factor into this, because it's looking at how much was earned by the tax versus how much was paid in cash transfers. Well, we had a huge increase in cash transfers from 2016-17 to 17-18. And so that compounded with the potential tax reform in 2018, I would not be surprised if this number is closer to down here, if not less. But in any case, it just kind of gives you a sense of the volatility and the uncertainty around a lot of these numbers. So these are the revenue estimates, and we're still estimating, 17, 18. The 446 is known. It's this 1.6 billion that isn't known. It's coming in at that level, but we still have and actually when I looked earlier this month at cash receipts for April, it was looking pretty good into the overall state treasury, and so I would anticipate we will see something around that number. Whether then I'm showing a lower projection. This is a 13% increase. I can't imagine that occurring again next year, but we'll see. And then trying to take that and translate it into the component funding for you guys, which is ultimately what you really care about. And the difference between those revenues and then these total funding amounts is the amount reserved for, the amount reserved at the state. And one of the things that occurs, so you've got just the regular administration basically through these fiscal years, but then in 1819, the state reserves 144 million for the California Housing Facilities Finance Authority, and that's really for the No Place Like Home debt service. So you see kind of a double whammy. You see revenues go down a little bit, plus an additional amount reserved at the state results in a fairly significant decline in revenues for next year. The state is projecting a higher cash transfer amount, so they aren't projecting as much of a decline. But given the decline in the annual adjustment, which is known, and the implementation of the No Place Like Home, I don't see how the cash transfers would make up that difference. So I would highly anticipate a decline in distributions next fiscal year. The other thing you'll notice, though, is we've kind of moved, from like a couple years ago, we're around 1.4, 1.5 billion was a sustainability level. I definitely think we're up around 1.8 billion now. So as you're doing your plans, definitely make sure you've adjusted kind of what you look at from a sustainability perspective to be more reflective of, the more recent revenues. And then you're also going to have to factor into this whole thing any of your AB 114 reverted funds. So that's just a quick update on the MHSA revenues. Any questions? We're kind of getting close on time here.
There's a question that it goes back to the previous section, I believe. Says if those were not part of the reversion calculation, will there be a second reversion calculation released?
So the state generally, as far as I know, has reversed or released two reversion calculations. They did an initial. In most counties, in fact, I don't know if any county at that point had submitted their 1617 RER, and so you end up with a bunch of gray shaded out areas where they still were awaiting the RER so they could do the calculation. Once they got your 1617 RER, they give you a new calculation based on the 1617 RER, and they call that the second one. But after that, then that should be it. There's also, folks were asking, can we submit revised RERs, and the state wasn't real clear. I think they prefer that you deal with it through adjustments to future year RERs, which brings up a bunch of different issues around, well, if you've reverted funds and then you adjust an RER that would have changed that, how could you have reverted funds? But anyway, I think I answered the question.
And one more question. Question on FSP percentage calculation. Can we use other funding sources besides MHSA funds to meet the 51% requirement? If not, was there an info notice that limits the use of MHSA funds only to calculate the FSP percentage?
So there were originally, when the and its majority of funds must be used for FSPs, the state allowed you to include all funding in that calculation. It seems like with the most recent RER that they changed that to only look at MHSA funds, and I'm not aware of any specific info notice where they did that. The other thing is, again, so the language in the, which is actually a regulation, is fairly vague. It says majority of funds must be, I think, must be used or budgeted or something like that, and that's the way it was interpreted. So it wasn't. I don't think it was must be spent. And so if you do not use the majority of your funds towards full service partners, my understanding is the only ramification is the state could come in and force a corrective action plan on you to where you need to get to that level. And small counties were exempt in the early years. I don't think we're still exempt from having to comply with that, but they can't withhold your use of MHSA funding unless they try to put that into regulation, in which case there'd be a huge fight, I would think, because it's, you never know. And all you can do is attempt to try to do that, which is really the intent, to try to provide because the MHSA itself was modeled after the RAP programs and the AB 2034 homeless program and whatever it takes kind of concepts. And so the goal was for CSS that you kind of model that. But I don't think I think the state would have difficulty taking money away from you or limiting your expenditures based on what you spent on FSPs. The state did initially say that you could use all the funds in the calculation, but I do believe the most recent RER only looks at MHSA funding, for better or worse. All right. Real quick, so then we move into county to county. There's some questions around the federal grant funds under Title II CFR 200, which requires a bunch of auditing and a bunch of other stuff. And so this has come up before, and my understanding is that it's not applicable to the Medicaid program. If you look at 2 CFR 200.502I, Medicaid is not considered a federal award unless the state requires the funds to be treated as a federal award. And I'm not sure DHCS has said that you need to treat these funds as a federal award, and then you have to comply with all these additional requirements. But I may be missing something on that. Shoshana already talked about the Fiscal Leadership Institute, June 4th and 5th. Should be exciting. County hospital cost report. And again, it's not really applicable to most of you folks, if any of you. And it's part of the supplemental payment state plan amendment and the ability to request the additional reimbursement. There was confusion around which cost report to use because some of these hospitals, and it's primarily the public hospitals, are audited significantly after, I guess, even when the short-term Medi-Cal audits occur. So they weren't sure which report to use, but it sounded like they were working on figuring that out. The AB 1299 presumptive transfer through Cal Mesa. So a couple of things we talked about there. One is that the Alliance has proposed a loan approach where the state would loan state general funds to counties for cash flow, but then the state would offset either the behavioral health sub-account, I'm not sure what, once there was more of a true up. And so even though that approach has been proposed, CBHCA wants to keep moving forward with the Cal Mesa approach. There are quite a few counties, at least as of the beginning of this month, that did not believe the data that has been provided is accurate. So I think there's more looking into that and whether the accuracy of the data, which really is trying to be used to determine how much each county should deposit with Cal Mesa. And so remember too, this is a voluntary thing where Each county can opt in or opt out, but obviously if most counties don't opt in, then it's not going to, it's basically a waste of time. We talked a little bit about the CANs and the PS35 implementation, and there's some concern around that the state general fund being appropriated for those two processes, or that process is not sufficient. But remember, again, this whole thing is ultimately settled through the cost report and ultimately through audit. So they may get an initial increase in appropriation, or they'll roll it into the next fiscal year, but then they're going to try to recoup it through audit ultimately. And then lastly, actually there were a couple of CBHDA questions for folks. One was a survey on county general fund, and I believe that's gone out, trying to get a sense of which counties actually receive additional county general fund over and above your 1991 realignment maintenance of effort. And then CBHDA has also asked for examples of the impact of no growth in the 1991 realignment, what that is happening or resulting in out in the counties. And I know for a lot of you folks, it's going to require more use of MHSA, more use of behavioral health sub-account, or restriction of services especially for non-Medi-Cal folks. So definitely, if you've got examples of that, you want to provide that to CBHDA. So that's it. Any questions on any of this? Or I'm sorry we went over a little bit, probably more MHSA than you wanted. No questions?
No questions.
All right. Well, thank you. And hopefully most of you will be at the Fiscal Leadership Institute in a little over a month, and we'll see you there. Thanks. Bye-bye.
Thank you.